Okay, good morning. I hope everyone's well. This pullback on stocks has bounced, just for now at least. We've hit the pivot on some of these markets, like the DAX, for example, pulling back to the pivot. Euro stocks nicely back to the pivot. Pretty sharp bounce for that Euro stocks, quite a good level around the 3,000 handle, which we've been talking about for the last few days. So another, interesting, bullish session yesterday, and weakness here at the open, but of course not lasting very long, and getting a nice lift off that first sort of key technical support that's been tested. Just looking elsewhere, look, the Bund has just popped up through yesterday's high. We're just pulling back to test it now. Of course, as equities were drifting lower, the Bund's been able to push higher, but now that equities have bounced, of course, the Bund is pulling back, but do be aware that is new all-time highs again on price, not on yield. We're about 0.44% yield on the 10-year. It's actually the 2-year yesterday on German debt that hit a record ever low yield. I think it was minus 0.46%, so substantially below the ECB's deposit rate of minus 0.3%, and certainly positioning for something more from the ECB, perhaps in the shape of another cut to that deposit rate. So a little bit of a pullback on equities at the open. That pullback as it stands hasn't lasted, and we're just lifting. Currency-wise, euro dollar just popped up through that high from yesterday as well, and now we've pulled back, and actually we're not far off. We're not far off the low of the session, but it's all quite tight here on the FX, and with oil we're kind of mid-range. I've got the daily chart on there, but if we just put a 1-hour chart, then as it stands, having had a big sharp move back to the downside. I mean, it was really a crazy day, as pretty much every day is for crude these days, but I haven't updated some of these lines actually. There's a few things around here. I'm going to get rid of that fib series. What I was going to say was, big solid drive to the upside through most of the European session yesterday. Then we hit the top, not quite getting back to that high point from the start of the week, but a big dive into the close as we had the biggest build from API crude inventory since 1996. When you've got a market that's oversupplied and you've got a market that is in one of its biggest ever downtrends, then the biggest build on crude for 20 years is not really what the doctor has ordered. 11.4 million barrel increase reported by the API last night to crude oil inventory levels. That is just an absolute monster. And so price came diving down. But I have to say, the grand scheme of things, looks like the market's kind of got away with it here a little bit. In that we didn't even make it back to $30. Now I say we didn't even make it back to $30. I mean, when you look at these moves on a percentage basis, they're just extraordinary. That sell-off into the close last night, 6.5% drop. 6.5% drop into the close off the back of the API numbers, but the range top to bottom, the lower 8 a.m. to the high at 6 p.m. was a 10.8% rally. So just in one session, 10.8% to the upside, followed by a 6.5% move lower into the close. Just quite breathtaking. Now, actually, so far today, it's been pretty stable. So let's talk about the news from overnight. Let's talk about China and, of course, Apple. And let's talk about maybe yesterday as well. I mean, what helped with the upside yesterday, if we just have a look at the 5-minute chart of the S&P and just go back, because we did get a nice boost. I guess a surprising result on the key data release of the day yesterday, which was consumer confidence. We bring this chart into screenshot here. We got a better than expected print at 93.3. And sorry, this is the wrong one, isn't it? Apologies. It's the other one I want. One sec. I'm not going to be able to find it now. Sorry. Anyway, I'll go with this one anyway. This is actually the wrong chart, but kind of gives you the same flavor, and that we got the highest number. Actually, I'm going to take this chart off. Basically, the consumer confidence print yesterday came in at a 3-month high, better than expected, and it was all the more surprising given the fact that, of course, we'd had such a chronic start to the year, and it was expected that that would feed through perhaps negatively in terms of how the consumer's behaving. But here's your big sort of paradox, because on the one hand, when you're an economist, or when you're a trader, or when you're an investor, of course you're fully embroiled in this, financial market panic. You're fully immersed in this negative sentiment and economic fears and all this kind of stuff. But if you're a consumer on the street, well, actually all that kind of stuff is, you're removed from it. And actually, what are you left with? Well, actually, some of these consumers are left with the lowest, cheapest petrol prices they can remember for years. And the labour market's strong. I mean, check out the non-farm payrolls pattern in Q4. So you've got this, if you look at things from the consumer's point of view, and you're not caught up in this financial market driven negative sentiment, then actually you could say things are pretty good. So in hindsight, maybe this consumer confidence number being better than expected is it just a bit of a wake-up call to say, actually, this isn't all doom and gloom. We're not necessarily heading for an inevitable US recession in 2016, and the Fed haven't even lifted off zero particularly, and the whole world's going to collapse. I think numbers like yesterday afternoon may be good reality check for us, and actually certain elements, powerful ones, and that's the US consumer, are actually still pretty solid and pretty resilient. So that's something to think about. It certainly helped with the move into the close last night. So actually, looking at this on a daily chart for the S&P, we've had the big bounce off that 20th of January low at 1800, and since then, and really this week, it's been it's consolidation of the rebound at the end of last week. But of course, the key thing is we remain below 1900. This is the barrier. We're still vulnerable to downside trends here. 1900 being breached would be significant. So we'll see. But looking overnight, let's talk firstly China. China disappointed. Actually, the Asian session was pretty solid apart from China, and a bit of panic over their industrial profits data, which again came in negatively. But this isn't new. China have posted negative industrial profits data. It came in at minus 4.7% year on year. This is for December. And we had expected minus 1.4%. So it was worse than expected, but it is, I think it's the 10th, or maybe not 10th, I think it's the 7th month in a row of declining industrial profits. So it's not like that's new. The People's Bank of China did set the currency, the yuan, actually, they fixed its midpoint below the close from yesterday, and indeed fixed it below the midpoint they set at the beginning of Tuesday's session. So you've got a little bit of, given that the yuan has been fixed pretty much unchanged, really since that first week of the year, which triggered all the panic, just be aware that they've sneaked it lower again today, really for the first time in a couple of weeks. And that might well have helped to generate a bit of nervousness in Chinese equities. We've got this fear about capital outflows, and it only takes a little sneak down in the exchange rate and that kind of flares up again. But what's really interesting is that you're not seeing it filter through to global markets. Have we kind of gone past that peak? Has panic peaked? Uncertainty is the big problem, right, with China and their policy. And maybe we're getting a little bit more used to this idea that China are engineering a cheaper currency, and that, ultimately it may well be a positive, it's going to be a positive thing for them perhaps in the end. Short term, it's a concern, but ultimately maybe this is a good thing. And I think it's interesting that today you have not got a global risk off the back of a depreciation of the yuan. So that's something to think about. Maybe another sign that the turmoil of 2016 is just, we're kind of over that panic period at the beginning of the year. So that's China. But look, let's talk Apple. And I don't know, it's hard. It depends on your viewpoint. You've got a real mixed opinion on Apple. I mean, it is the biggest company in the world, but the big takeaway certainly from the media's point of view, the headline is, of course, that Apple have indicated that the quarter that we're in now, so quarter one of 2016, will see their first decline in iPhone sales, since the iPhone was born, actually. However, they managed to sneak an increase. This is year on year, right? So this is annualized, stripping out seasonal effects. The quarter into the end of December delivered 75 million iPhones, which was about 0.5% higher than the same quarter in 2015. So they did deliver sales growth or unit sales growth in quarter four, but only just. They sneaked it in. But what they've guided us towards is that they expect this quarter that we're about to start, we're in now, will see a year-on-year decline in sales. And so that's compared to quarter one of 2015. And this is the big news, okay? It's that, everyone's been talking about, is this the beginning of the end? I saw a headline in one of the papers this morning, peak Apple. Has Apple peaked? Is this the beginning of the end? I think it's way too early to start panicking about the beginning of the end. I mean, the doomsayers love a headline like, first ever iPhone, annual sales decline. But also, one interesting stat in amongst the conference call from Apple was that they now have 1 billion active users. And this is actually a measure that we haven't really heard Apple talking about ever before. And I think it's definitely a very conscious strategy move by the management team to start talking in, almost like in Facebook language. 1 billion active users. That means people actively on an Apple device using an Apple service in the last 90 days. 1 billion of them. That's obviously the iPhone, the iPad, the iWatch, it's the Mac, it's the Apple TV, add them all up, 1 billion. Now that's pretty interesting. And the thing about it was that's 25% growth in a year, apparently, on that measure. I think that's quite interesting, given the phenomenal monopoly they have really still in the app world. And when you think about things like iTunes, I mean, these are services that are just absolute monsters, and yet nobody really pays too much attention to them because they've got an even bigger monster in their locker, which is the iPhone. And all right, they've seen we're expecting some weakness ahead, and inevitably their growth, especially in China, has just been mesmeric. And so, given China risk, of course, that's looking a little weaker. And probably at the end of this year we'll get iPhone 7 and a new. We are in this period, the second year of the iPhone 6, and so that adds into the fact we might get a bit of weakness here. So I don't know. It depends how you look at this. Just looking at a couple of other charts. By the way, they smashed their record to deliver yet again the world's biggest ever quarterly corporate profit in the history of mankind. So it's not like it's all bad news. This isn't a fallen giant. It's still growing. And all right, we've got some concern about the quarter ahead, but I think personally, this is not the beginning of the end. It might be the beginning of the end in 12 months if iPhone 7 fails. Sure, but I think here's the share price, right? Now, here's the Apple share price over 5 years. And we're around a really very, very key significant price point, which is $100. We have been below it this year. We've been down to test the $97 handle. look at the key resistance that's provided back in 2012. And, we've had a pretty significant decline here off $132 high. And sure, that was probably too high up there. And obviously in hindsight, it's easy to say that. But, from a valuation point of view, these guys are trading at 10 times earnings. And that is cheap when you compare it to the rest of the index. So on a valuation basis, this is not expensive. It's anything the opposite. And, if basically the market isn't pricing them right, in that they're just pricing them as a handset sales company, when really they've got a huge amount of services. All right, the Apple Watch failed. That's definitely something that has added to the bandwagon, which is that Apple are peaked. But I think personally, I think we can see that all-time high again, maybe by year end, if iPhone 7 gets delivered and it's a good upgrade. Obviously, there's a lot of ifs in that, but I don't think this is the beginning of the end yet. So this looks quite interesting around these prices. But I'd say, of course, in the near term, it's about China first and foremost, and that goes really for global equities. Are we going to see a stabilization in China risk? Are Chinese equities going to stabilize? They made another 13-month low today. So as it stands, they're still going down, but we're getting some pretty alarming volatility. But for me, the most interesting thing of all is that Chinese volatility is not translating into the European session as it stands. All right, let's have a look at the calendar for today. So from Europe, again, not much of interest. We've got some Italian confidence numbers. Actually, on Italy, we have seen quite potentially importantly, we have seen Italy striking an agreement with the EU on bank loans this morning. It's quite important for Italy. It's quite important for Renzi's government. And so this is an agreement on a guaranteed scheme designed to help Italian banks sell their large portfolios of non-performing loans to private investors. The idea being to ease market pressure on the financial sector. This is quite key, I think, for Italy's medium to long-term prospects. So that's quite a good result. But unrelated to that, we'll get consumer confidence, business confidence, and economic sentiment from Italy. These aren't big numbers at all. At 9:30, we're going to get mortgage application numbers from the UK. Of course, Carney talking about specifically the buy-to-let market yesterday. So perhaps this will get a little bit more interest than it ordinarily would. But again, generally speaking, a pretty quiet day for data out of Europe as it was yesterday. So this afternoon, two big events. I mean, we've got new home sales data at 3 o'clock, but I'd say the two big events are crude inventory numbers, given the extraordinary figure delivered by the API last night, 11.4 million barrels. We'll see what the Department of Energy's got to say. Current forecast, 4 million. So that's at 3:30. And then the Fed decision tonight, of course. And they will leave rates unchanged. So it's more about the statement. And all we want to see is, have they been affected by the global negative sentiment that has been displayed in financial markets in January? Have they been influenced by that? Will they deliver a more dovish message than December? I think ultimately they're going to have to do their usual, which means they're going to have to use language like every meeting is live. We could potentially raise rates in March. It will be data dependent. But then, of course, if they truly are data dependent, well, then some of the data has deteriorated. And so, services PMIs yesterday coming in below expectation. It's a mixed bag, though, because we've had some good payrolls numbers. And confidence data in the consumer space is strong. So it is a mixed signals on the data front. So we want to see, are they being affected by China? What about oil and therefore the negative spin on the inflation outlook that brings? Is this going to lead to a more dovish statement or not? And basically that's it. I mean, they're not going to raise rates tonight. There's no Yellen press conference. It's just all about the statement at 7 p.m. So we're going to be covering that tonight live in real time. We'll be doing a full FOMC preview early afternoon, okay, in the build up to that at 7 p.m. Outside of that, we've got speakers in the shape of a bunch of ECB guys: Coer, Lane, Mersch, Lautenschlager, who's my favorite named ECB member, and Shafiq from the Bank of England coming in at the European close. So that's the lineup. With regards to earnings, I mean, we've had the big one of the week really with Apple, and it is a mixed bag from their share price point of view. They held pretty steady actually, around about that $100 mark, despite beating expectations for Q4 last year. It's their forecast, it's their guidance towards this year that's grabbed the headlines. So we'll see. Apple shares will be in focus when the US session gets going later on. All right, so let's see. As it stands right now, bit of a dip on Europe at the open, a bounce off the pivot. The bounce hasn't got us that far. We haven't got back to the top. Actually, I guess with the DAX, we almost got back to the top. You can see now that's kind of run out of steam. So we're kind of mid-range here now. Keep your eye on oil. You know, I think those API numbers from last night have to be thought about. I think that ultimately the low from last night, which is today's low at 30.28, if that gets broken, we're going to be sharply below $30 quickly. But that level's really important. The lower the day on oil, and will certainly guide equity markets as we go through the morning. All right. Enjoy the session. Thanks.